In finance, gravity usually dictates that when risk goes up, asset prices come down. But right now, that relationship has stalled. Historically, the relationship is straightforward. When macroeconomic uncertainty rises, investors pull their money out of equities and park it in safer assets, driving stock prices lower. Look at what's happened since late 2024. The US Economic Policy Uncertainty Index has climbed to a 40-year peak, yet the US stock market hasn't collapsed. Instead, it's pushing to all-time record highs, rising in lockstep with the exact metric that usually destroys it. At first glance, you might assume investors simply stopped taking risk into account, shrugging off geopolitical tensions and economic hazards entirely. The soaring stock market is actually detached from how investors are behaving. It's hiding a fundamental divergence in the financial system. To find where investors are actually putting their money, we have to look past the equities market and examine the broader financial ecosystem. Since late 2024, the US Treasury bond market has lost 15%, wiping out $300 billion. The US dollar index dropped 10%, and $50 billion fled US money market funds, the largest outflow in a decade. This movement of capital illustrates a strategic retreat. Investors are moving out of American assets in direct response to that elevated uncertainty. If historic amounts of cash are running for the exits, why exactly is the US stock market still sitting at all-time record highs? The answer lies in the metric we use to measure the market in the first place, the purchasing power of the US dollar. This chart tracks the purchasing power of the US dollar. For 35 years, it has been on a steady downtrend, but in 2021, the decline accelerated. The dollar is currently shedding purchasing power faster than at any point in the last 3 decades. This drop began when US inflation heated up. As inflation rose, the currency's ability to buy real-world goods and services deteriorated. Put simply, a weaker dollar makes everything that is priced in US dollars look more expensive, and that includes stocks. The object hasn't changed size, but the numeric measurement appears to go up. To see if the stock market is actually growing, we have to remove this nominal distortion and measure true corporate earnings. Once you adjust for the dollar's devaluation, the growth disappears. Since 2021, US corporate profits have been completely flat. The stock market's current performance is largely a byproduct of currency math. These highs track the dollar's devaluation rather than any real growth in corporate profits. We're left with a severe divergence, stagnant corporate earnings against a skyrocketing S&P 500, a gap that's widening. In 2001, we saw an identical setup, a massive gap between flat profits and spiked stocks. Eventually, gravity pulled prices down to align with actual earnings. Today, inflation has started to tick back up again. It's risen from 2.4 to 4.2. The entire market can continue to melt upward right up until a true economic recession breaks the spell.